Hey guys, it's Big Mike of BigMikeTrading.com. So continuing our series of answering some questions that I receive. This guy wants to know, when are the Fibonacci guys going to admit that it's all BS? Seriously, when did 50 become a Fibonacci number? Okay, so here's what I said, and then I'm going to go into some more detail. There are such things as self-fulfilling prophecies, meaning that if 90% of the traders think that a 38.2 or 61.8% retracement has a lot of meaning and they trade that, then guess what? It's going to, in fact, have a lot of meaning. But most of the time, I believe in this, I'll call it random line theory. And really what it comes down to, I ran this test, and for the YouTube watchers, I'll put the link to the random line theory thread, which has a lot of great discussion, down below the video. But I have to warn that the thread seems to be misunderstood. So here's what I tried to do. With that thread, I used a random number generator from a website called random.org, and it's been a long time since I created this thread, so I'm trying to remember. But I think that what I did is I entered, it was back for oil, I think, when I was trading oil, and I would enter like the weekly low and the weekly high as the two, minimum and maximum numbers. And then I think I was generating 4 random numbers every single day. I was generating the night before. So, Sunday night, I would generate the random numbers that I would use for Monday. Wednesday night, I would generate the numbers that I was going to use for Thursday. So it was well in advance. I posted them well in advance. And these were completely randomly generated numbers. And I put them on a chart, posted everything in advance. And lo and behold, wouldn't you know that when the following day came, it looked like the market was respecting these random lines, We would see price trade right up to a line and then slam on the brakes as if there was resistance there. And then we would see price come back to this other randomly generated line. And it was almost as if there was support. Now, you guys need to know, I've been through it all. I've been through all the Fibonacci stuff. I've been through the Murray math lines and all these other kind of lines. And there are just 1,000,001 indicators out there to throw some sort of a horizontal line on your chart. Okay? And really, the general question that this guy is asking actually applies to a lot of different indicators, not just horizontal lines in panel 1, not just support resistance indicators. I mean, this could apply to CCI and MACD and RSI and everything else. And here's what I think. I think that, first of all, just because you're trading a 4-range chart or a 1,000 tick chart or a 4 Beta Renko chart or whatever, it doesn't mean that everyone else in the world is trading that. Now, there are some givens across multiple time frames, like swing high, swing low, but you have to keep in mind that when you're looking at a really tiny chart, the swing high, swing low may be, 15 minutes old. And if you're looking at a daily chart, the swing high, swing low could be, weeks old. So when let's take the Fibonacci example, whenever you're drawing a retracement, the daily trader may be seeing a completely different 38.2% retracement than the small intraday trader, because the daily trader may be going back 2 weeks ago to that swing high to draw his retracement, whereas the intraday trader may be going back 10 minutes to draw his. So there's really not a lot of confluence between the Fibonacci numbers from one time period to another or time frame to another. The same thing is true of pretty much any type of traditional indicator, like any type of an oscillator or any type of a histogram. More or less, they're all, like 99% of them, are all dependent on the time frame that you're running them on. Okay? In fact, I'll even throw in, I've seen people who were trading on Interactive Brokers data, which is snapshot data. They filter the ticks and only send you burst of ticks. It's not true unfiltered tick data. And then I've seen these people move to different data feeds, Zenfire, Rhythmic, whatever, Trading Technologies, whatever it is. And they're getting a lot more ticks now. and they're like, oh, all my indicators changed. I like my old way better. Well, I mean, doesn't that prove, if nothing else doesn't that prove that the indicator itself has nothing to do with really anything? If you liked the old way better, it was simply because you became accustomed to the old way. You started to develop a sense of the market based on what it was doing around these indicators. And then the indicator didn't change, but what changed is you're now receiving more market data, not more price data, but more market data, a more complete picture of the actual ticks if you're using a tick-based chart. And now all of a sudden you don't like the indicator anymore. This is true of moving averages, CCI, RSI, whatever. Moving average is going to be different on a 5-minute chart than it is on a 60-minute chart. The only thing that's not going to fall into that category is the VWAP, the volume weighted average price. That's going to be at the same level no matter what size chart you put it on, okay? Which is actually one of the reasons I really like the VWAP. So if you go look at that random line theory, and you can see, first of all, it was misunderstood because people literally thought that I was trying to, what's the word I'm looking for? Trying to say that this random number generator is generating usable signals, that I should trade from. That completely missed the point. The point is that you think that these signals are actually useful. How about this? If I hadn't told you it was random, and if I had told you I slaved on this indicator for 3 years, I thought about selling it for $3,000, but you know what, friends? Here it is for free. It would have been downloaded 5,000 times and people would have been going all crazy for it, okay? But instead, I told them the truth and I said it was completely random. And the point that I was trying to make is that your mind plays tricks on you. It looks like that price is responding to those levels, but it is not, okay? I don't care if you use pivots. I don't care if you use square of 9, and I can't even think of all these other ones out there where they have all these horizontal lines all over the place on the chart. The fact is that just because you think price stops or respects at a certain level, it doesn't mean that it has anything to do with that indicator or that level. The truth is, your indicator might match something as common as yesterday's high, or as common as yesterday's close, or maybe as common as today's open, that kind of stuff. If you're looking at weekly pivots, floor pivots, for the longest time I was a big fan of floor pivots. And let's face it, floor pivots are much more simple than like a Murray math line, for example. They're based on just open, high, low, close. It's not any kind of special math. They're 38.2 or 61.8 or whatever type of a stuff. And I liked floor pivots, but the truth is that really you can use them or you cannot use them, but price is always telling you the same information if you just go look. If you just know where the weekly high is, or you just know where the weekly low is, or you just can kind of gauge the halfway point between today's close and yesterday's high or whatever, you're going to be able to visualize these things on your own. And I think you're far better off doing that than you are trying to load up your chart with all these horizontal lines, because then you start to assign weight to these lines, and they really don't deserve it. Okay, these lines don't deserve your attention or your admiration because they're not special, and in fact, they can do damage to you because you can start to rely on them. You can start to count on them. You can start to take trades solely because price is coming up to a gibberish line, that makes absolutely no sense in the terms of the market, and you're going to lose. Naturally, you're going to lose. So that's my answer to that question. Hope it's been useful, and no disrespect to anybody that is trading Fibonacci or anything else that I mentioned, because the point that I'm making is not that Fibonacci is gibberish. The point that I'm making is that it's how you perceive it. Okay, it's what you do with the information. Now, Fibonacci is actually a little bit special because there's a lot of people that use Fibonacci. There's probably a lot more people using Fibonacci than there are using Murray math lines as an example. And I don't mean to pick on Murray. I just can't think of any other indicators right now, and I'm sure that Murray has put a lot of work into his indicator. But the thing is that in terms of a self-fulfilling prophecy, if there's a lot of people that are going to just go short automatically at a 50% retracement or go long or whatever, then it kind of automatically becomes a self-fulfilling prophecy. Not that 50 is even a fib number, like this guy was saying. All right, guys, hope that's been useful, and please subscribe to the channel, and I'll be posting more of these Q&As soon.